Hey everyone, and welcome back to Money Journey. Today we are diving deep into one of the most intriguing stocks of the year, StoneCo. Now, Stone has been making headlines, but not for the right reasons. It's currently trading at a 52-week low, and its recent performance has been, well, less than stellar. But why is this happening? What's going on behind the scenes? In this video, we'll break down the factors contributing to Stone's decline, scrutinize its fundamentals, and assess its valuation. So, if you are curious about the future of Stone, stick around. We'll uncover the truth and help you make informed investors' decisions. Let's get started. Imagine running a small business in Brazil. We've got customers, we've got products, but managing payments and transactions can be a real headache. That's where StoneCo comes in. StoneCo is a leading fintech company in Brazil that provides technology solutions to small and medium-sized business. They've revolutionized the way these businesses operate by offering a comprehensive suite of financial services. Here's how they make money. First, payment processing. They provide point-of-sale device and software that allow business to accept various payment methods, including credit cards, debit cards, and digital wallet. They charge a fee for each transaction processed. Second, financial service. They offer a range of financial services such as loans, working capital solutions, and insurance products. They earn interest income on loans and fees from other financial services. And in third, software solutions. They develop and sell software solutions to help business manage their operation more efficiently. They generate revenue through software license and subscription fees. By providing a comprehensive suite of financial and technological solutions, StoneCo has empowered small and medium-sized businesses in Brazil to grow and thrive. StoneCo is an incredible high-quality company with a great business model. And when we look at the fundamentals, it's a reflect of that quality. It's a $3 billion market cap. It's trading at a P of 8.5 and a forward P of 7, which looks incredibly cheap when you look to a price to earnings ratio. They have been growing around 41% per year, their revenues. Gross margin, since it's a payment service, a technological company, it's difficult to evaluate this company looking at their margin, but it is really great margins. Their returns have been average, I would say, but they have been growing up, and in the future I do really believe they can have higher returns on invested capital. Right now the return on invested capital is around 10%, which is the minimum we like to see. When you look at our money journey checklist, it's all check marks. Revenue growing above 40%. They have really great gross margins and net margin and free cash flow margins. Their let is incredible low, so they, even though they have plenty of loan business, which is they need a lot of money to fulfill the loans for their clients. But even with that, it's a technological company, really great margins and not much of capex, I would say. So they have a low debt. Returns on equity and on invested capital, it's pretty average, but going up. And since it's a company which is growing a lot and with really great margins, I do believe they will have higher returns in the future. They have a big competitive advantage on Brazil. They own their peaks, which is like the Venmo of Brazil, I would say. So it is an incredible. They have plenty of competitive advantage, and I would say it's a pretty wide moat. They have been free cash flow positive, and right now the most thing I love in Stone, and they are returning capital to the shareholders right now. Not doing a dividend, but doing buybacks. They start this year, and right now they increased their buyback program to 2 billion reals, which is around 350 million dollars, which is more than 10% of the company at the valuation we are seeing right now. StoneCo was a growth company. They were growing a lot, but their growth started to slow down. Right now they are expecting to grow between 10 to 15% a year, which is really good. Not 40% as we are used to, but still a really good growth. And looking at their valuation, they are growing faster than their PE ratio. So their PEG ratio is like 0.5, which we don't find that often. With these share buybacks, that could be really good. We can see very good returns on StoneCo in the future. Right now, in 2024, they bought back 3.5% of the shares outstanding. And since we are seeing a lower valuation in terms of PE ratio right now, they might be buying even 5, 6, 7% of the company just this year, which is incredible. I really love to see this opportunity for the Stone shareholders. Fundamental wise, incredible, and this lower valuation, lower price could be an incredible opportunity to shareholders to increase their position in StoneCo, and even for the company to buy back more shares to increase your position in the company. So this could be really good for the future returns. In terms of valuation, it's more complicated than that. Bear in mind, we are investing in a Brazilian company. Always there are a lot of risks. I would say investing in Brazil it's riskier than investing in China. So for me to invest in a company like StoneCo, I have to assess this risk, and of course I will have a higher margin of safety. So for a Brazilian company like this, my base case will have a discount rate of 16.4. Bear in mind there are plenty of risks. Even though this is a great company, there are still a lot of risk investing in Brazil. So that's why I use a bigger margin of safety. But I'm assuming they can achieve 20% margin in 10 years. For my growth rate, I will be conservative, I would say. So they are expecting to grow 10% this year and 13% next year. So I will expect them to grow around 11% until the 5th year and 8% after that. So a PE, I will assume 18. A little bit of premium because they are growing fast, have great margin and incredible business model. I could use a lower PE and use it as my margin of safety, but I prefer to use my margin of safety in my discount rate. So for my base case, it's a discount rate of 16.4%. This is my base case. Bull case and bear case, it's more optimistic and a worse scenario. And with that, I came with an intrinsic value of $15 for StoneCo. Right now, the company is trading at $9.5, so it is a big margin of safety right there. Even with my big margin of safety in my discount rate, StoneCo still looks incredible cheap in my opinion, but this is just my opinion. Of course, you shouldn't invest because I say it looks cheap. So to wrap up, Stone is undoubtedly a fascinating case study. While it's a fundamentally strong company with a solid business model, it's been caught in the crossfire of Brazil's volatile economic landscape. The recent 90% decline is a stark reminder of the risks associated with investing in emerging markets. The political and economic instability in Brazil can significantly impact the performance of even the most promising companies. From a valuation perspective, Stone appears incredibly cheap. However, this cheapness is often a reflection of the underlying risks. Before making any investment decision, it's crucial to weigh these risks against the potential reward. As always, do your own research and consult with the financial advisors. So, I hope you liked this video on StoneCo, and if you like, please like and subscribe. See you next time.